Hello, everybody, and welcome back to this series of financial analysis. Today, we are going to be looking at Mitie, the Mitie. So my name is Ted Wainman, and the aim of these sessions is to show you how to read and interpret financial information. Warren Buffett said that the language of business is finance, and if you are fluent in business finance, you become fluent in business. And so what we're going to do is we're going to look at Mitie and see what the numbers are telling us about this business. So for those of you who've never heard of Mitie, here's a little bit of information about it. It's a strategic outsourcing, so the use of the word strategic, but it's an outsourcing and energy services company, provides infrastructure consultancy, facilities management, property management. So, you know, if you're sitting at the office and you have a landlord who owns the building and you're in a business and you occupy the building, then these guys are going to do the empty the bins and fix the air conditioning and sort out the lighting, probably provide the security on the front desk, etc., etc. Okay, and there's more to it than that, but that's kind of generally what they do. Head office is at the Shard here in London, but lots of other smaller offices dotted throughout the United Kingdom and in Ireland. So that's what they do. And what we're going to be looking at is the financial information that sits behind this this company. So this is a request. This is actually a request from somebody who has decided that at some point, they call him Christian Lagarde, ex-DC, XRP, ISO 022. So a kind of, you know, basically sort of called anywhere between the latest cryptocurrency or Christian Lagarde. I'm not sure this is Christian Lagarde, who is, of course, as you well know, the chair of the there's the kind of the chair of the European Central Bank. But anyway, this individual has been very persistent in asking me to have a look at Mitie, so I have finally given up and relented. So once again, please do remember, if you'd like me to have a look at a company, then just leave a note in the comments section. And while you're there, please do remember to like, share, and subscribe. So do remember to click the subscribe button. If you like this video, then please do click the kind of the thumbs up. Please do share it with your network, with your colleagues, with your friends. And remember that we're not here to give investment advice. We will look at the share price in a minute, but we're here very much to help you understand the finances sitting behind this company. So maybe you're looking to bring these guys in to manage your building. Maybe you are looking to pitch to them and turn them into your client. You want to be supplying to them, and you want to know a little bit more about the organization. Maybe you're going to be working for them. Maybe you already are working for them, in which case, please do share some of your insight, because, you know, I'm going to give you my perspective, but this is merely one perspective. I don't always get everything right. And that being said, if you are going to share your perspective, please do remember to be polite. In fact, we have very polite people. All of our subscribers on this channel are very polite, which is always obviously fantastic. So let's, without any further ado, jump in and have a look at the financial statement. So here is their financial statements. You'll notice it's a fairly sizable a document running to 228 pages, and this document is available on their website. And what we're going to do is we're going to whiz through the kind of the statement by the chairman, all the key numbers, what they do, why they do it, where they do it, how they do it, what their strategy is, their corporate governance, remuneration of the board, etc., etc., etc. And we're going to go all the way down to the financial statements, and we'll find the financial statements come just after the audit report, and they are down on page, if we can find it, they're down on page about 147 of 228. So we're going to go down to 147 of 228 to find the consolidated income statement. So here is the income statement. For those of you who have been watching these videos before, you'll notice I like to concentrate on the total column. I tend to just ignore this kind of this other items, because people like to bring it, oh, it's a kind of a one-off in it, and it won't happen again. And you kind of happen to see, well, you know, while it may not happen every single year, it seems to be pretty consistent. So I like to look at the total column. Interesting enough, there's a little bit of sort of restated going on here. Sometimes we have to kind of update the prior year. So we are in pounds millions, and so therefore the total revenue, the turnover for this company is a total of 3.9 thousand million, so just shy of £4 billion, okay, which is a significant increase on the previous year. Now, do remember the previous year will have been COVID. And so quite interesting that, you know, maybe there's a big sort of COVID element there, or perhaps this increase is driven through business acquisitions. So what you find is that a lot of these types of companies will have grown through buying other companies, and we'll be able to see that as to where that growth is coming from as we dig further into the accounts. The cost of sales, this is the cost of providing the services. So this is the cost of emptying the bins, and the cost of paying the people on the front desk is 3.5 billion, leaving them with about £500 million, 451 million pounds in profit. Okay, now that's a pretty tight margin. That's 12%. So it's a 12% of the total revenue, a 12% gross margin. They then got the cost of running the business. So the admin expenses is rent, rate, light, heat, sales, marketing, HR, finance team, facilities, IT, and all the kind of, you know, the costs that you'd expect to see as part of running a business. By the way, when I mentioned rent, it's the rent that they pay, you know, on their offices in the Shard, not obviously the rent that the offices that they are managing. So about £400 million, and really that just leaves them with 72 million profit. That's a 2% operating margin. So that's incredibly low. And look at the previous year, it was only a £4 million profit. So these guys are basically operating at pretty much break even. Now, I've worked with a couple of companies in this space, and I know that it's incredibly competitive. So, you know, if you're running a business, you'll have people like Mitie will come in, they'll pitch to you, and these guys, you know, it's a really, really low margin business, and the companies which are really lean and very well run are the successful ones. So you can see that very, very low margin. They've got some finance costs. And the finance cost, well, you know, they can cover those finance costs, so 20 million. So the interest cover is looking okay. Again, the previous year it wasn't so good, but you know, this is just really, really low. And I get it, because you know they've got to be competitive in terms of their bids, and they're probably running this as tight as they possibly can. So hence they're trying to say, look, you know, there's a bit of a kind of a, you know, maybe a one-off or a special item, and really you should be looking at this number as kind of the core operating profit. But you know, as I said, I kind of like to look at the, you know, the total number and not get distracted by, you know, things which people think aren't going to be one-off. So profit before tax, 52 million. They're paying tax on that, and they end up with a profit for the year of 31 million. Now, they do have some discontinued operations. So they've obviously pulled out of one part, and their discontinued operations is 14.9 million, which leaves them with a 50.7, or nearly a 51 million pound profit. Okay, that's basically 1%. Okay, so really, really, really tight margins, and just not a lot of room to maneuver in terms of their profitability. So very, very low margin business. Go down to the balance sheet now. Here's the balance sheet. So non-current assets, so things that we need to run the business. There they are. So 738 million. If you think about it, you don't need a huge amount to, you know, you need a kind of couple of mops and some screwdrivers, and that's it. And off you go, and, you know, look after your client's premises. I'm being obviously a little bit simplistic there. So, you know, they don't have a lot of, you know, their property, plant and equipment is pretty small. They've got some other intangible assets, which is interesting. So we might just go and have a look at note 13 to find out what that is. And here we can see the goodwill. And so the goodwill has increased, suggesting that they have grown the business through acquisition. So again, you can start to see from the income statement that there's some companies that they say, well, we don't really want to be in this sector, and so they're selling part of their organization, and then they're saying we don't want to be in this sector, and they're buying another company that's already in that sector. So don't forget, lots of reasons to buy a company. Maybe they're just trying to expand their top line. Maybe they're trying to buy access to technology, to licenses. These guys will buy access to contracts as well. A company has a long-term contract with, a particular client. They buy the company. Effectively, they take on that contract. So that's a sort of a usual way. And don't forget, when they're buying a company, they're buying the income stream. They're getting the net assets. These companies don't really have a lot of assets, and so this is where the goodwill will be generated. So we kind of expect that from the goodwill. So I'm meant to be looking at this. This is the previous year restated, 295 to 301. So it's not a huge amount. So it looks to me like that increase in revenue that we were talking about, 56%, is really coming from more organic. And I'm guessing that that's going to be COVID related. And I would expect that a lot of their clients would have pushed back on these guys and said, look, there's everybody's staying at home. There's no need to run the building, so we want to renegotiate our contracts with you and reduce that down to a very sort of just basic service. Current assets, here the current assets. So again, as we'd expect, no inventory. They don't sell anything. They sell a service. They've got trade and other receivables. Those are the clients who own the money. They've got some cash in the bank, and between those two, that ends up with just over, nearly 1.1 billion pounds. Okay, so 300 million in the bank, 700 million owed to them, gives them just north of 1.1 billion. Okay, so total assets 1.8 billion. Okay, nothing we wouldn't expect there. Are we just going to go and have a look at that note 13, won't we? So let's just have a quick squiz at the other intangible assets. So here we are at note 13, and we can see that of the total intangible assets, so total intangible assets are 258 million. We can see that if we look at the columns, we can see that a lot of it is these customer contracts and relationships, and then we do have some software. So they do have their own in-house software, but most of it is down to this customer contracts and sort of and really this is acquisition related. Now, I don't know exactly how they've kind of worked this one out, because most stuff on acquisition, the intangible on acquisition, is reflected in the goodwill, but somehow they've kind of and I mentioned this before, that these guys will often buy companies. They're either buying out the competition or they're buying access to an existing contract or relationship, with the hope that they can deliver a really good service, retain that contract, retain that relationship, etc., etc., etc. We've got a net book value of 250. I guess the point you could say is you can't put that on eBay and sell it. Okay, so when we're looking at if you're talking about it from a net book value, that's just a theoretical amount rather than a physical amount, so to speak. The same with goodwill. So let's go back to the balance sheet and continue our analysis. And here we are now looking at the liabilities. So current liabilities, amounts that we have to pay soon, and by soon I mean within a year. Total 1.1 billion, biggest number, trade and other payables, as we would expect. Now, this is our first little kind of warning light that those of you who are regular viewers will know that we like to compare our current assets to our current liabilities. That gives us what's called our current ratio. And the current ratio in this example is 0.94. That says for every £1 these guys owe and have to pay soon, they have 94p either as cash or coming in as cash soon. And that's a little bit of an alarm bell. That's just a kind of a little, just says, hold on a sec. That sounds to me like it's not overly it doesn't sound very good. Their net current assets, which is this number here, is total for you, is actually their working capital. So net current assets, these two numbers added together gives you a negative 71. Okay, so these guys have negative working capital. Now, it's quite possible to operate with negative working capital. They have no inventory, and it looks to me, back of an envelope calculation, that it takes them 65 days to collect the money in from their customers, and it takes them 82 days to pay their suppliers. Now, those are very rough figures using the numbers in front of me, but effectively what that means is that they get the money in from their customers 16 days before they pay the money out. Okay, and that allows companies like this to operate at a negative working capital effectively. However, I would suggest that, if you're a supplier to these guys, then, that's going to be quite tough for you. So if you are a supplier to Mitie, be prepared for some pretty, tough negotiation. And these guys will push back and pay your bills as late as possible. 65 days from their accounts pay, from their receivable, sounds like quite a lot of time. And again, that's going to be reflected in things like, they're going to do some work, but, they can only bill on completion, etc., etc. So we don't know whether, what those numbers don't tell us is that industry normal, or are these guys, is this basically, a big number because these guys just, really can't afford to pay their suppliers. Okay, so there's a kind of little bit of a question mark around that. And, they've got 300 million in the bank. I'm not suggesting that these guys are going bust, but I just think that, cash is tight, their margins are tight, cash is tight, and therefore they're going to squeeze their suppliers as hard as they can until the pips squeak. In their non-current liabilities, biggest number is their financing liabilities. Now, I would expect that will be our, sort of basically the debt. So you've got a little bit of short-term debt, a little bit of long-term debt sitting there. You'll notice that the numbers have changed a little bit. That isn't necessarily a problem because it could just be that this was short-term debt from last year that now becomes sort of, repayable now. You'll see the previous couple of years are given to us there. Again, little bit nervous. It just says that, you guys, they have to give 171 million back. They should be able to refinance, but again, you go back to the income statement, look at their interest compared with their operating profit, and there's not a lot of money left over. They are running they're running at very, very close to the wind, so to speak, on this. Net assets 425 million, and there is the equity making up that 425 million. And again, we notice that these guys are sitting on retained losses. So they have been making losses in the past. They have this is the what's been actually invested into the company, and they've got this thing called a merger reserve. Own shares held own shares is basically where they bought back their own shares. Merger reserve is really an accounting adjustment, so I wouldn't worry too much about that. But these guys, they've taken a fair amount of investment and they are sitting on retained losses. So just to remember that. Movement in equity gives a little bit more information. We're really interested in this company, this line here, so the retained losses. So the retained losses at the beginning of the year, they had 150 million of retained losses. They made a profit of 50.7 million. You remember that came from the income statement, and they did pay out a dividend. Not a very big dividend, and there was no dividend in the previous year, so they are paying a little bit of dividend, and then they got some share-based payments. This is really incentives to staff, etc., etc. So it's kind of they're not paying out a huge amount in terms of a dividend from these guys. Last one to look at is our cash flow statement. Now this is quite an interesting one. So we have the kind of the profit figures up at the top here, and then they make these adjustments to turn them into cash. Now they've given 3 numbers in cash, so let's just explain what these are. They've got this is the cash flow from the operations. Okay, so this is kind of what you might call core cash flow, and what they then do is say, what's the effect of movement in working capital? Now basically working capital is 3 things. It's inventory, accounts receivable, and accounts payable. So if you buy more inventory, in fact these guys, they've seen that they've got less inventory, so they've sold inventory, they've got more cash, but they don't really have inventory because they're a service company. Increase in receivables, if you don't bill your clients, then your clients don't pay you, and therefore you have less cash. Now, I'm not saying they're not billing their clients. Don't forget their turnover has gone up, and if their turnover goes up, the amount of money that they're owed by their clients goes up. But it does mean that they have less cash. And then again, on the other side, increase in payables. If your costs go up, therefore you will owe more money. But the interesting one is that their costs have gone up at a greater extent than their receivables have gone up. So that suggests to me they've got more money in from their customers than they have paid out to their suppliers. And so these guys really look like they're squeezing their suppliers in order to make sure that they are generating cash. So I would kind of focus on this one as a kind of a core number, that the 203.9. and recognizing that the rest is just movement in working capital. And the point is, in terms of this movement in working capital, is you can't carry on generating cash by using your working capital. You can only do it on a short-term basis. Investing activities. So here's our acquisition of a business. So there's the business that they acquired. They also disposed of a business again. So looking to me like that 56% increase in revenue is very much driven by post-COVID. And as I said, these guys, they'll go in, they'll provide basic building services to companies, and then they'll do sort of additional work, and they'll make a lot of their money through extra works. And it looks like that, during the pandemic, they just went down to, really basic, just providing the basic service while those buildings were closed. So acquisition, disposal of buildings, and then a little bit of purchase of property, plant and equipment. And we've also got the dividends. We've got dividends being received. Interesting enough, they haven't got any dividends. Dividends being paid will be so dividends being received. So investing activities 26 million, and then down here we got the financing, which is so they're doing a little bit of share buybacks. They are paying out dividends. There's the dividends that they're paying, and this is the capital payment of their lease rentals. So some of that interest will be regarding leases, right of use assets, and this will be the capital element of that. So effectively paying down those loans. And that leaves them with positive cash flow over the year. Total cash, positive cash 150 million. Start with 200, finish with 350 effectively. So that's the difference between these two numbers here, is represented by that 149, and there's a small forex difference. Don't forget they are in Ireland, so they'll be dealing in euros as well as pounds. So there we go. Those are the numbers. Nothing else really to kind of look at. EBITDA margin. EBITDA isn't really relevant to these guys because they don't have a lot of depreciation and amortization, because they don't have any assets, and they don't have a huge amount of interest to pay. So EBITDA is 4%, again, just very, very low margin. So very, very low margin, very tight balance sheet, very, very competitive, very difficult to make money. It is possible in this business, but it's a really, really tough old game. So let's have a look at their share price. Just pull up their share price. Here it is. So in terms of their share price, it is bouncing around a lot. Our market cap is 900, so nearly $1 billion on the market cap. If you remember, their that's about well, I reckon it's about 20 times earnings. They've got a P ratio of 35 times, so perhaps that suggests maybe that's based on a quarterly earning. Dividend yield of 2.5%. Really, I reckon that's pretty low. P ratio 35 times. I think that's pretty high. I mean, that's and maybe they're looking at, people look at this and thinking, well, this is a defensive company. But I wouldn't be filling my boots on a P ratio of 35. Even based on my figures, it's 20 times earnings, and I still think that's pretty high for a market where the FTSE itself is trading somewhere between 10 and 15 times earnings. It's very, very cheap at the moment. So these guys do not look cheap at all. And you're paying 131% more than net book value. So the book value of the company, 426 million, that's the net assets, and of that net assets, most of it is intangible and goodwill. So without the intangible and goodwill, you basically got no assets at all, nothing you can kind of really sell. So you're just, it's all pure earnings. It's all pure, sort of future profits. So there you go. There's my take on Mitie. It's a tough company. It's very competitive. It looks like it's going to, I haven't got experience of their actual service, but there's no gremlins in the accounts. However, I can't see this guys, they're not going to double in value, then double in value again, and then double in value again, unless they, they can really snap up some of their competitors at very, very competitive prices. So I hope you found that useful. Once again, please do remember to like, share, and subscribe. And I hope you've enjoyed this video, and I look forward to seeing you on the next one. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.